Risk is as important as return when it comes to investing, but how can we quantify the benefits of diversification? Well, that's the life's work of Harry Markowitz, and in this video we celebrate his modern portfolio theory, we dig into what it means, but we also look at the practicalities of investing and selecting assets based on his theory. This video is sponsored by Trading 212, which is a UK commission-free investment platform. So let's look at modern portfolio theory in a bit more detail. Now, Harry Markowitz died this year at the age of 96, and he really was foundational in applying quantitative theory to portfolios. So his thesis in 1952 and a paper he published that year went on to earn him the Nobel Prize in 1990. And as you can see, Robin Wigglesworth describes him as the OG quant, the original gangster. But he was actually a very modest man. And when people were enthusing about his Nobel Prize, he actually said he thought his greatest achievement was in the men's room at a large Washington hotel, where he'd gone to give a speech with the co-winners of the Nobel Prize. So that was Bill Sharp, but also Merton Miller. And when he was in the loo, the person at the next stall said to him something which deeply moved him. "Thank you, Dr. Markowitz, for creating the profession in which we all earn our living." And he said that that was actually better than winning a Nobel Prize. So what I'm going to do is go through 3 problems which I think he's addressed in finance, which have revolutionized our understanding of investment. The first problem is really fundamental, and that's what we mean by a good portfolio. Now, one way to approach this is simply to maximize your return. How could you do that for a stock? Well, for every stock, you could estimate its future dividends, you could discount them to today's value, and then you could just work out the one which gives you the greatest upside, the greatest return. However, the fundamental problem with that is that we don't know what the dividends will be in future for stocks. So how can we go about building a portfolio given that uncertainty? That's what modern portfolio theory addresses. Now, before modern portfolio theory came along, people understood diversification. Of course they did. You don't want to put all of your eggs in one basket. It was all about anecdotes like that, and it wasn't really quantifiable. People understood that there was a kind of tug of war between risk and return, but it was quite difficult to work out exactly which assets would reduce the risk while keeping the return high. So people understood that what they were trying to maximize was their personal wealth by investing in high return assets, but they didn't want to lose sleepless nights in order to do that. That was the intuition behind the theory. So what the theory tried to do was work out the minimum number of units of risk you had to take to generate a certain number of units of return. So the return divided by the risk would be as large as possible. And this led to another ratio which is incredibly useful, which is the Sharpe ratio. And William Sharpe was one of the people who was awarded the Nobel Prize alongside Markowitz in 1990. The only difference in this ratio is that we subtract the risk-free rate from the return, so what we're looking at is an excess return in the numerator. Think of that as the return that an investment gives above the risk-free rate, which is usually a government bond yield. Now, the theory is incredibly useful. For example, when Bernie Madoff was running a huge Ponzi scheme in the US, this chap, whose name is very similar to Harry Markowitz, it's Harry Markopoulos, he worked out using the Sharpe ratio of Madoff's returns that there was something funny going on. He actually had almost 30 red flags which he discovered, but the Sharpe ratio was a key one. And what he showed was that the Sharpe ratio for the index which Madoff said he was replicating was only about 0.43, whereas the Sharpe ratio of Madoff's portfolio was an unbelievable 5 times higher than that ratio. And it remained that high for about 18 years, which Markopoulos said was impossible. Now, before we go on with the video, let me quickly mention Trading 212, which is a commission-free UK investment platform, which I've been using for some time now. Now, it's not just about low cost, it's actually very innovative as well. For example, it has fractional shares. So if there's a very expensive fund, you don't have to pay the full amount for it. You can just buy a fraction of the share. It's also got a feature called pies. And the idea here is that you can either copy someone else's pies or you can create your own pie. But what it is a set of assets which forms a kind of mini portfolio. Rebalancing that pie is incredibly easy. You just do it with a click of a button. And you can publish your pies so that other people can benefit from your research. They also now have a feature where you can earn interest on your uninvested cash. So let's just look at one of those pies and how you make it. It's really very easy. You just select the assets that go into it, and then you make sure they add up to 100. It also comes up with an estimate of what the return will be on that pie, and then you can simply allocate cash to it, either via regular investing, which is a great way to be disciplined about investing, or you can just fund it manually. Now, Pension Graph viewers get a special offer from Trading 212 where you can earn a free share worth up to £100. Now, in order to claim that share, all you have to do is open a new account with Trading 212, verify it, deposit at least £1, and then use the promo code, which is my first name, RAMIN, Romin. Another thing which modern portfolio theory allows us to do is to work out and quantify exactly the benefits of diversification. Let's take a look at a really simple example where we've just got two funds and we're working out how much to allocate to those two funds. The first one is a Vanguard S&P 500 tracker and the other one is a US Treasury tracker. So this is US government bonds. So we've got stocks, we've got bonds. The question is, how do you combine them to minimize the risk of your portfolio? In order to illustrate that, I've used one of the diagrams which Markowitz came up with in 1952. And I use these in a lot of my videos. You've probably seen them before. We've got risk along the bottom, defined as volatility. That's a typical annual percentage price move of an asset, with high volatility on the far right and low volatility on the far left. And then on the vertical axis, we've got low return at the bottom and high return at the top. So the line that you can see on the graph, that kind of bow shape, that's called the efficient frontier. And what Markowitz showed was that for a given level of return, there's a minimum level of risk which you can achieve by combining assets in your portfolio. So in this case, notice that the stock fund has a volatility which is just under 17%. And the volatility of the Treasury fund is much lower, it's only 11%. But by combining the two, something magical happens. We can construct a portfolio where the volatility is under 10%, lower than either of those. The reason for that is that they have a low correlation. In other words, they diversify one another rather well. So the key point here is that Markowitz showed that correlation is really important when it comes to diversification. Intuitively, it makes sense. You don't want to buy more of another asset which is copying the returns of the first asset. If one of them zigs while the other one zags, they kind of cancel out each other's crashes. So that's really important when one of them takes a big tumble, and it reduces your overall portfolio risk as defined by volatility. But what if you take two assets which aren't uncorrelated? Two assets which are highly correlated, and in this case it's two stock funds. One of them tracks the S&P 500, that's the one that we had before, and the other one tracks a global equity index. Now, regular viewers of this channel will know that there's a roughly 60% overlap in the stocks between those two because the US market is just so big. And that stock overlap means that the returns of the two funds are actually quite similar. And that means, according to Markowitz and modern portfolio theory, that the diversification benefits will be limited. Notice that in this case, the efficient frontier isn't that kind of bow shape. It's actually just moving from one asset to the other. The risk never reduces significantly below the risk of either of the funds. Now, of course, there's a penalty that usually comes with that diversification. Returns are usually a little bit lower than they are when you just go for equity, say. You can see that when we compare the cumulative return of those three funds over time. The Treasury fund is the one at the bottom and it has the lowest returns. But the key point here is you should always be aware of the correlation of the assets in which you invest. So I can show here the correlation between those three funds. If the correlation's plus 100%, then effectively they have identical returns. They track each other up and down day by day exactly. If the correlation's minus 100%, then they do the opposite thing to one another. And if the correlation's around zero, then one does something and it doesn't affect what the other one does at all. Now notice if you read across from the equity funds, you can see that VUSA and VWRL have a correlation of almost 97%. Whereas if we compare the correlation of VUSA and VUTY, which is the Treasury fund, that's only 13%, a very low correlation. And that's where the greatest diversification benefit comes from. Now, in the past, I've tried to visualize that using something called a Scooby-Doo tree, at least that's what I called it. This takes that correlation matrix and turns it into a tree, such that the nodes of the tree which are close together, in this case the two stock funds, are the ones which are the highest correlation. So what you're trying to do here is choose bits of the tree which are as far apart as possible. And that way, you can very easily and visually diversify your portfolio by choosing assets which have a low correlation. But it all stems from Harry Markowitz. So here's a portfolio that somebody showed me a while back, and you can see the correlations amongst the investments which they've made. For example, they've got lots of life strategy funds from Vanguard. Now, why would you have more than one of these? You can see they're all highly correlated with each other. They've got Life Strategy 100, 80 and 60 in the same portfolio, even though they're highly correlated. There's no diversification benefit here. They're essentially just buying more of the same thing. And sometimes the correlations are more subtle. For example, the Baillie Gifford Fund and the Midwinter International Investment Trust. So by looking at the correlations amongst the assets in your portfolio, you can first of all simplify your portfolio. You could just narrow it down to one life strategy fund, for example, or maybe one growth fund. But also when you're building your portfolio, you can choose assets which have a low correlation to your existing portfolio members. And that way, the new addition to your portfolio will have a dampening effect on the overall risk, as well as hopefully contributing new return. Another problem which I think modern portfolio theory addresses is simplifying the act of building a portfolio by reducing the number of dimensions we have to think about. And the problem is that there are just so many things in which we can invest. For example, there are over 50,000 companies which are listed on stock exchanges globally. If we look at the stocks which are just in a global index like MSCI All Country World Index, that has about 2,800 stocks in it. And in the US, if we look at exchange traded funds, there are roughly the same number of those, about 2,800. How do we make sense of those investments? Well, we can just plot them on a risk-return plot, and immediately we can see for every fund in the past, what kind of return did it generate and what risk did we take in order to generate that return. And the very best funds will have a low risk and a high return. In other words, they'll be very close to the upper edge, to the kind of left-hand side of that efficient frontier. So let's take a look at an example. This shows various stock indices and currencies and commodities globally, and we've put them on this risk-return plot, which Markowitz championed and created. So we can see immediately that the NASDAQ index has done very well over this period we're looking at, which is 2008 to 2023. It's got a very high return. However, it's also got a very high risk. So we should be aware of that when we're investing. If you invest in the NASDAQ, maybe the returns will be good, but the risk will certainly be high. If you look at the FTSE All World Index, it's lower down on returns, but it's also lower down on risk because it's better diversified. But of course, there are some problems with Markowitz's modern portfolio theory. Now, a lot of the assumptions of the theory when he developed it are not valid. Those are kind of obvious. Things like trading costs weren't included, taxes weren't included. But I think the most obvious problem is using volatility to represent risk. There are actually lots of risks in investing which simply aren't captured by volatility, by those price movements up and down, because some things are very risky but not very price wobbly. For example, illiquid investments. If you look at the value of a shopping mall, for example, if you buy commercial real estate, it doesn't sell very often, so the price doesn't fluctuate much because we can't observe the price. But it is risky. If we buy high yield corporate bonds, some of them don't trade for a week at a time or 2 weeks, and that means their price movements are not very volatile. But they are risky because these are low quality credits and they're quite likely to default. So your capital is certainly at risk when you buy them. So credit risk is another thing which is poorly captured by volatility. And people who bought Russian assets may not have seen huge volatility in Russian stocks just before Russian assets were effectively frozen. But now they're in a situation where they can't get their capital out of those assets. And that kind of geopolitical risk also is not captured by volatility. But let's finish by looking at how we can use Markowitz's ideas to build a portfolio in practice. And I always see it as kind of like a job interview where you're interviewing an asset, an investment, for inclusion into your portfolio. So I always imagine that I'm sitting the asset down in front of me with a checklist. The first question is always, what kind of return are you going to generate? Will it be good? The second question is more to do with risk. How volatile are you? How crashy have you been in the past? Have you suffered huge falls in price, which have lasted a very long time and taken a long time to recover? But thanks to Harry Markowitz, a third question which I might ask is, how correlated are you with my existing investments? If you're uncorrelated with my existing investments, then you bring something very special to the party, and that's diversification. And that's going to reduce my overall portfolio volatility, and that's a great thing. So you can probably tell I'm a huge Harry Markowitz fan. I think his work is so important when we build portfolios now that we don't even think about his contribution. So I think we should give him some credit for what he's done and for an incredible life that he lived and his contribution to finance. Now, don't forget, if you do want to learn more about Trading 212 and claim a free share worth up to £100, just use my name as the promo code, RAMIN. And you'll also see a link in the description which explains how to claim that. And, as always, thank you for listening.